tax reform was the fairy godmother of corporate earnings. So corporate earnings, and we've talked about this here a lot, the thing that drives markets is earnings. Earnings drive markets, earnings drive markets, earnings drive markets. So there were 2 quarters in the last 30 quarters where earnings, expected earnings were increasing mid-quarter. When were those 2 quarters? First quarter of this year, second quarter of this year. That means even though we knew that legislation was signed, even though we knew that the tax rates would be a benefit to corporate America, we didn't know how good it would be. We underestimated how good that benefit would be for corporate America. And it is an incredible boon. So first quarter, second quarter's not in yet. First quarter, 25% increase in earnings on a massive economy. 25% increase in earnings. So this is the earnings across this is March 31st. So in the quarter, you see that earnings estimates are increased across the board. Every single sector. So it's positive across the board. The green is the beat rate. So everyone knows that corporations manage earnings expectations. And so there's usually a beat rate that's above 50%. The S&P beat rate right now is 78%. 78% of the companies that report earnings report better than expected earnings. 78%. 17% have reported below expected earnings. It's the percentage of the companies that are reporting earnings that are greater than expectations. They beat their earnings estimates, the beat rate. So when you have a surprise, the long-term average of a surprise in earnings has an effect in terms of stock price. And what we're seeing right now, the negative surprises are yielding a negative, so this is the long-term average, 2.4, currently 2.3. So when something reports a negative, it's being reflected in the stock price the way you'd expect. When someone reports a positive, it's not being reflected in the stock price the way you'd expect. Do you have any idea why? The downside would be met with, oh yeah, that makes sense. We have a negative earnings surprise, the stock market goes down. But if you have a positive earnings surprise, it doesn't go up the way it has in the past. So this 1.1 is the historical, how the prices move, 5-year average, how the price of a stock moves when there's a surprise earnings on the upside. This is how it's moving right now. We're not seeing a market adjustment to say, oh, good job, surprise on the upside. So what he said was, maybe it's because the tax benefits are going to be realized this year, and then the real benefits aren't going to be there anymore. So let's frame it a different way. From an investor's perspective, I want a company's earnings to increase, but I want them to continue to increase. I want them to increase not on a one-off thing. I want them to increase by more sales of widgets and services, right? I want them to actually do more business. This is not them doing more business. This is them receiving a one-time, here's a benefit, which is wonderful, but this is what the forward-looking PE ratio, it was 18.5, it's now down to 16. Look at the average, 5-year average, and then 14.25 is a longer-term 10-year average. So we dropped because the market didn't move, and because earnings did move, we dropped to a pretty reasonable forward-looking PE ratio, where we used to be sort of overvalued. We're less overvalued now. But wait. You remember looking at the CAPE ratio? Remember talking about the CAPE ratio? So the CAPE ratio is Shiller's average earnings over a 10-year period ratio, okay? So what happens, those of you who are here, you might remember that there's 3 things that we sort of anticipated would happen. 2 big ones. Let's talk about those 2. One, we said earnings are going to go up, right? Tax rates, there's no question earnings are going to go up. They're going to go up a lot. That's what's happened. So that's thing number 1. But what else happens next year? So it's 10 years. This is a horrific, oh, that's really overvalued. But remember what the 10 years are. 2008, 9 through 17. So what happened in 2008, 2009? Recession. So not just recession, earnings went to 0. But why did earnings go to 0? What was happening? Not just recession, not just financial calamity. They were writing down their previous 4 years of earnings. So we got all the bad stuff in 8 and 9 in this calculation, None of the good stuff in 6, 7, and 5, 6, and 7. Right? So all the bad, negative things that happened that we overpriced and we claimed earnings that didn't exist in 5, 6, and 7 came off the books in 08. That's still in this ratio. So that's holding it up a lot higher than it actually is. So when you hear CAPE ratio, you have to recognize that it's not as bad as the pundits are saying, because they don't peel the onion. They just go, oh, it's a horrible number. But there's a lot in that they're not looking at. So I think this is actually a pretty good indication of what the value is forward looking. I think this is a pretty good indication.